Our next guest says gold could sink as low as $8.50 an ounce. We had this guy on yesterday. I wish you would have been. I wish we could get him on a phone. With us now on set, Adam Grimes, CIO and Director of Tactical Investments at Waverly Advisors. And it was classic because I said, well, because he's back to $2,000 gold, he says, near term. And I said, well, how long have you been long gold? To find out how long he's ridden it down. Right. And he said, since 300. I go, okay, so you ran it up. Have you been bullish all the way down? He goes, well, I bought it at 300. I go, yeah, but it would have been a good time at 1900 to say something has changed. Would it not? Absolutely. What changed, and why will it go even further low?
Well, I think what we see is a few things have changed with gold. You know, gold is no longer the safe haven store of value that we think of it traditionally.
What is? The dollar.
I don't know. The dollar, cash is probably the safest place to be a lot of times. Gold is trading as a risk asset. Gold is trading much more like stocks, crude oil. It's trading very emotionally. We can sit around and speculate on why. Maybe it's the rise of exchange-traded products and, more of a retail mindset. Who knows? Maybe it's just a natural
Why did it run
evolution.
up to 1900?
I think a lot of what has been driving price dynamics over the past 3-4 years in gold seems to be mostly psychological factors. And if you look at the way gold traded up around 1900, it was the kind of classic climactic, buying climax, blow-off thing. And we actually were able to initiate a short the day of the high. And that was just based on structures that we saw in the price.
When the people that get very nasty with me and tell me that I don't understand what's going on are people that say that it has nothing to do, it's not a commodity, it is an actual currency. It is the actual only store of value in a fiat world, in a paper world, and that you're not really understanding economics if you don't understand that it isn't just, it's almost different than any other asset, is the point that they make.
Well, that's the argument, but I think what is different in gold is the emotionality, is that a word, of the market participants. How vehement are gold bugs about their position?
I've seen other people like that in certain stocks that
at certain times,
that,
right?
Certain times.
The markets go through phases.
The Tasarians,
right.
The Blackberrians right now.
Right. And I think what we see is that this makes a market, whether gold is a shiny rock, a commodity, the ultimate store of value, and it may be in 20 years, it may be in 50 years, we may be having a different discussion.
Is it wrong? Go ahead.
Doesn't it make you uncomfortable to be short something if it's all traded on a psychological basis anyway? I mean, that can turn against you at any point, too. Well, if there's not fundamentals that you're really basing any of this on.
Right. Well, the issue is, we're talking about prices like $8.50 is the price target that we're thinking is out there. And it's not a case of, we manage actively. And if we saw something change in the dynamics, we could very well be long. It's not like we're going to short and close our eyes and say, we're right. We know it's going to $8.50 and pound the table.
But is this a speculative market? I mean, if it's a speculative market, people need to realize that when they're getting involved in it.
Telling a market is not a speculative.
Yeah, but this one feels like it's just so emotionally
I agree.
Run at this point.
And that is where I think, when you see a market that makes you emotional, that's a time to step back and say, perhaps fundamentals are not driving.
It's always been like that with gold. But I wonder, people that got in a year ago, Einhorn, people that are fairly strong, what were they still thinking it was because of the printing presses globally?
That was what Einhorn said at the time. Remember, he wrote that whole thing.
God almighty, but that I would have thought that what ran us up from 300 to 1900 was we knew that a lot of the private debt was going to be taken on, the financial crisis. It was going to be taken on by public entities, and therefore you had to print to pay for all of that. So that would make sense. But we didn't see what the worst case scenarios were saying, and that would be a collapse of all currencies. We didn't see that.
Right. That argument would have made sense to me perhaps in 2008, 2009, 2010.
And that's why it ran up, right?
2011, 2012.
Is that why it ran up to 19?
Certainly that was a motivating factor, but I think the real acceleration came in 2011 when a lot of those fears, at least in some quarters, had subsided.
What about different cultures that just value gold and jewelry, and there's not enough, and they're not making any more of it? Do you have to think about that wedding season in India, something like that? Or?
Well, you basically no. You don't see. There was a time, maybe in the 70s and 80s, when you saw more cyclical fundamental drivers of price in gold, and you could tease out some cyclical seasonal components in prices. You don't really see that so much anymore.